Hello, everyone. We're going to get started today and keep everything moving. There's a lot to cover, and we have a big group of experts that are going to give you updates on all this. So I just want to welcome everybody to the webinar today. Hopefully you are in the right spot. Today we are reviewing OBBB Review and Strategic Updates, Guidance, Clarifications, and Key Tax Insights. So hopefully that's where you want to be and what you thought you were learning about today. So I am Carolyn. I will be your host today, also go through some of the housekeeping, but our experts today are going to do some clarifications on the new act that was passed in July. We had a webinar on that, but hopefully you were on that one. If not, you went back and watched it, but we'll do some review and give you some of the updates and clarifications, kind of things that clients have been asking us about. We'll go through those with you today. Just to get started, somebody's saying my mute mic is muted. Maybe if somebody can tell me if you can hear me. Hopefully you can hear me, or I'm just talking to myself. All right, well, I will continue on. Hopefully you can hear me. In the housekeeping today, there is the handout, a copy of the slides you can see in the handout section. Also, too, there is a question section. Feel free to put notes in there. If you can see me, hear me, and see the slides, put that in there or ask us any questions. I do see one question has already been put in there. We will get that answered for you, Diana. Also, too, after today's webinar, we will send an exit survey. It will automatically go out to you. If you could complete that for us, be great to get feedback. Let us know if you want to talk to one of our experts, if you have any additional questions and topics you would like to hear about in 2026. This afternoon, I will send you an email with a link to the recorded session, another copy of the handouts, so that way if you want to go back, watch something again, or share it with somebody else, you'll be able to do that. So we have a whole team of experts with us today. They all have a great background. So we have Lisa Merkel, Stefan, Connor, JJ, and Kevin with us. As you can see, they're all from our small business and tax departments, ranging in experience and length at the firm. We have some CPAs, some non-CPAs, an EA, a little bit of everything here for you today. And I am going to get us started with one poll question before I turn it over to our experts. So just give me a minute to get to our poll. And the question is going to be, I am, or I have. We'll kind of let our experts know where you're at. If you've attended this webinar back in July, do you have a base understanding? You think you're an expert, you have no idea, this is the first time you've heard of it. Where do we think our group's going to be, experts?
Hopefully everybody was here in July.
Hopefully.
That would be ideal.
Everybody's understanding.
Hope everybody's lost.
You can educate them, make them feel all good. We'll give everybody just a minute on the question, just to help our experts, and they can maybe adjust their conversation, take it to the 201 level or stay at the 101 level. And I will close this out in 3, 2, 1. I'll just share it real quick with everybody. So it seems like a good group of people attended it back in July and have a pretty good understanding of it. So it looks like we'll just be giving everybody the updates. So I will hand it over to JJ to get us started on those updates. Thank you.
Thank you, Carolyn. Let's see if my camera's working. Thank you, Carolyn. Hello, everyone, and welcome. I will be covering the One Big Beautiful Bill introduction and overview. The One Big Beautiful Bill was signed into law on July 4th, 2025. The act essentially extends the 2017 Tax Cuts and Jobs Act and makes some of those tax provisions permanent. The act provides key tax provisions to the following areas: extension of individual income tax rate adjustments, small business and entrepreneur tax relief, corporate tax modernization, family and community support incentives, green and strategic investment tax credits, and termination of some energy incentives. I'll take the next slide, please. Thank you. There are some general business provision updates. Increased Section 179 expensing limitations and bonus depreciation, which is made permanent at 100%. That Stefan will be going more in detail about shortly. Updates to C Corp charitable contributions, full expensing of research and experimental expenditures, expanded qualified small business stock under IRC Section 1202, federal Social Security and Medicare tip credit expansion. The FICA tip credit only applied to employers in the food and beverage industry and is now extended to include tips in connection with the beauty services industry. In Form 1099 NEC and miscellaneous reporting, this threshold was raised from $600 to $2,000 for the years after 12/31/25, and it is increased. In 2027, the $2,000 threshold will be adjusted for inflation. And then here are some general individual provision updates, extended income tax rate adjustments, and then some increased standard deduction and itemized deduction opportunities. They are sales and local tax deduction limitation cap, which is increased to $40,000 for 2025 and further to $40,400 in 2026, and by an additional 1% in 27, 28, and 29. Auto loan interest deduction on new vehicles. And then senior deduction, taxpayers age 65 or older can claim a $6,000 deduction per individual for the tax year beginning before January 1st, 2029. Extension and enhancement of qualified business income deduction. 20% QBI deduction is made permanent, which was set to phase out after 2025. Extended opportunity zone incentives, enhancement of child and dependent care credits, tax deferred investment accounts for children, and no tax on tips, overtime pay, and Social Security, which Lisa Merkel will be talking to you about next. So I'll be turning it over to Lisa now.
Thank you, JJ. Well, hello, everyone. It's great to be back. We are here today to round out some of the, I hate to say it, but probably not final information with regard to the changes in the tax law. Most likely just some updates, and we will be covering today. I'll be covering the no tax on tips and no tax on overtime. So I'll start with no tax on tips. This was part of the act that was passed on July 4th, 2025, and is part of the larger tax regulation that included no tax on overtime, which was also enacted. I'll be covering that shortly. So if the individual is employed at an occupation considered eligible by the IRS and the Treasury, I'm going to just have you jump to the next slide there. They can deduct up to $25,000 in qualified voluntary tips, those not part of a mandatory service charge from gross income, and I'll get into what that means in just a moment. Married individuals must file a joint return to claim the deduction and can be claimed whether the taxpayer itemizes or claims the standard deduction. Begins to phase out for single filers with modified adjusted gross income, which has a new definition under this provision, of over $150,000, and for joint filers over $300,000, and fully phased out for $400,000 for single filers and $550,000 for joint filers. So there is a phase out of $100 for the phase out of $100 for every $1,000 by which the taxpayer's modified adjusted gross income exceeds $150,000 for single filers and $300,000 for joint filers. This is a deduction that is retroactive to the first of this year and is temporarily in place from 2025 to 2028. And so only those tips that are received in occupations that are customarily and regularly received tips on or before December 31st of 2024 are eligible to be deducted from income. So the tips must be paid in cash or cash equivalent, such as a check, credit card, debit card, gift card, or another form of electronic settlement or mobile payment application denominated in cash. Of course, Venmo is a good example of that. Qualified tips do not include some service charges. So this is about what I was referring to earlier. This is going to be the automatic gratuities that sometimes are imposed on larger parties at restaurants or venues. I'm familiar with, everyone's probably familiar with that 18% service charge for large parties, and distributes that to the wait staff, bussers, kitchen staff. If the charge gets added with no option for the customer to disregard or modify it, it is just, and it's distributed to workers. Those are not considered qualified tips. So I think it's possible we could see changes in the collection of gratuities by restaurants and venues so that they are more voluntary in nature, thus allowing those taxpayers to be eligible for the deduction. So that remains to be seen. We're keeping an eye on that. So there was some recent guidance by the IRS in about late November that provided clarification on how workers can determine the amount of their deduction for 2025 without receiving a separate accounting from their employer for cash tips or qualified overtime, which I'll cover shortly, on information returns. So these are going to be the W-2s or 1099s. The W-2s and 1099s are not required and will not be changed for 2025. Next year, 2026, those forms will be modified and will also include a 3-digit code, which is an occupation code. This is coming from a list from the IRS for occupations that receive tips. There's about 8 categories, starting with 100s down to the 800s. Beverage and food service, entertainment and events, recreation and instruction. So a few examples, DJs, estheticians, a private athletic coach, in addition to all the other ones that are fairly obvious, our bartenders, servers, etc. So again, next year, we will become a lot more familiar with these codes as we see them appearing on our W-2s and 1099s. Okay, so the IRS, the notice that I referred to is providing transition relief for transition rules for 2025 to give employers, other payers, and payroll providers time to adjust their systems and reporting processes. So in an earlier notice, employers were encouraged to provide employees with a separate statement with cash tips, but they're not required to do so. Do know of some forms that exist out there to help workers and employees and employers, you know, kind of work on and communicate what tips are and what tips are going to be voluntarily reported. Form 4070, 4137, not used much in clients I have with restaurants, but in talking with a restaurant employee and actually looking at their pay stub when they received tips, you can see right on there. And we're going to be able to use I think it's box 7 of W-2 that reports tips anyway. So that's primarily what we think is going to be the amount that will be going onto the return and be reflected in a new schedule that I'll cover as well. Always a new form for a lot of these changes. So hopefully between the normal cash tips reporting that we see on W-2s, the fact that a lot of our major payroll companies that I've talked to are ready to roll this out and provide employers with statements to give to their employees. Hopefully it won't be too cumbersome this sort of transition year. Okay, we already talked about the codes. I think that'll be coming out next year. So independent contractors actually also qualify for this, the self-employed community. So by using earning statements, other documentation such as receipts, point of sale systems, point of sale reports, daily tip logs, third-party settlement organization records, or other documents that support their calculation. These self-employed individuals, again, can qualify for this deduction and only can deduct up to $25,000, the lesser of $25,000 in tips or their net income. So I have a client who owns an aesthetic spa. Just to give an example, so she rents space to massage therapists. They are self-employed, and they regularly receive tips, so often through Venmo. So I can see where they would be reporting those tips and then excluding them if they are eligible based on their income and other factors. All right, so we're going to move on to Schedule 1A, our lovely new form here. So this is a new schedule to accompany the 1040 for certain individuals. It's in draft form at this point. So this form is going to be able to calculate phase outs, allowable deductions for several new deductions for the bill, tips, overtime, the car loan interest deduction, the senior deduction. All of them are going to be subject to a very similar calculation in terms of modified adjusted gross income. different from what we're used to. And it's going to actually be adding back to income, income that is sourced from certain foreign territories, US territories. So kind of a new definition of modified adjusted gross income for these purposes. So the schedule is going to calculate the deductible tips and the phase out that is applicable to the taxpayer. Again, fully phased out at $400,000 for single and $550,000 for joint filers. Unfortunately, I wanted to end this on a high note, this section, but it appears that New York, unfortunately, will continue to tax tips by adding new codes for add back of exempt tip income on Form IT 225. So unfortunately, New York is not conforming to the new federal tax provision for tips. All right. So we're going to move on to another hot topic here. This is going to be the no tax on overtime. Maybe less taxes, more hours, more money, but and maybe less taxes. So again, this is a temporary deduction for tax years 2025 to 2028. It's often described as no tax on overtime, but the legal mechanics and limitations are really important to understand for both the employers and the employees. It allows taxpayers to deduct from their gross income up to $12,500 or $25,000 for joint filers per year of qualified overtime. Overtime compensation received on their specific information returns, again, their W-2, and in some cases 1099s, although we don't see overtime reported on 1099s really ever, but that probably will change. So it's available to employees and the self-employed, provided the overtime is in line with is required under the Fair Labor Standards Act or the FLSA. So it's only going to be the half portion of the time and a half for hours worked in excess of 40 hours a week. And it's also available whether the taxpayer itemizes or takes the standard deduction. And so then we have some phase outs, once again, very similar. So we're again using that modified adjusted gross income concept, newly defined for these deductions of $150,000 for single filers and $300,000 for joint filers, and basically reduced $100 for every $1,000 that exceeds that threshold. The Social Security number has to be stated on the return, and if the taxpayers are married, they have to file jointly. So this is a deduction that is for qualified overtime. That's a key concept, qualified. It's not for wages. It's not for all wages or for all overtime that is allowed by employers. It's only that overtime that is required by the FLSA, such as, so not for example, for a premium that is paid for working a holiday, or in some cases, employers may pay double time and a half. It's only for the and a half portion of the time and a half. So what exactly does no tax on overtime mean? So it's not a complete exclusion from gross income altogether. It does appear on the tax return and in some cases get excluded. The employer still has to, the taxpayer still has to, this is all subject to all the payroll taxes, Social Security, Medicare, and federal withholding. The individual who claims the deduction on their personal tax return reduces their taxable income by the amount of the deduction up to the cap and subject to the phase outs. So overtime pay is still subject to payroll tax withholding, which is income tax, Social Security, and Medicare at the time it's paid. So the employee may not feel a difference right away. The taxpayer is going to basically feel the deduction, the benefit of the deduction when they file their annual tax return come tax time, which may result in a bigger refund or reducing a balance due. The deduction reduces taxable income, not the liability directly like a tax credit would. Little income tax 101 there. It's going to depend on the taxpayer's marginal rate for that year. So it's not truly tax-free in the sense of being excluded from gross overtime, gross income, as I said before, or exempt from all types of taxes, just the reduction in taxable income up to that statutory limit. So in terms of compliance and, as far as the reporting is concerned, employers and payers are required to report the amount of qualified overtime compensation on these information returns, with the caveat that I'll get to in a moment, on those W-2s. There has been some guidance that's been very recently issued to provide for some transition relief this first year, since it's also new. The W-2s and so forth could not be modified in time since this was just passed in July. So it's our understanding the IRS is really not going to go crazy with penalties this first year because they do know it takes time to implement these changes. And like I said, we're all just still digesting the guidance just that came out a couple of weeks ago. So again, just to define qualified overtime, it's that and a half portion of overtime that is required under the FLSA and is in excess of the regular rate at which the individual is employed. All right. Okay. So what does this mean for the employee's actual paycheck? So it's a deduction and it's a deduction and the real tax benefit reduces taxable income when you file the tax return. Employees will, we understand, get the opportunity to revise their W-4 in the coming year, should they wish to reduce their federal withholding if they are regularly subject to overtime and want to see the benefit of this deduction in real time each week in their paycheck, rather than waiting till tax time. All right, we've covered the phase outs. I think I can have you skip. Okay, so we've got regular wages, straight time, bonuses, shift differentials, weekend premiums, all of these count as overtime. Again, holiday pay does not qualify. So some temporary steps to take now, or I'm sorry, practical steps to take now. Talking to your payroll vendor, if you haven't already, if you are a business owner, make sure that they, you're on the same page in terms of the rules and regulations, and that somehow, some way, overtime will be tagged and provided in some sort of way to the employer and employees. With regard to that, it really can't be the W-2 right now in many cases. It will be next year through 2028. We're still in that transition time. Payroll companies, from what I understand by talking to a few of our major companies, they will have statements that they can provide and feel as though they're ahead of the game and should be able to provide employees with the information they need for their tax return. And of course, we want you to always consult with your tax advisor, your tax professional. Things can get a little confusing. This is a limited deduction on certain overtime, not a blanket tax exemption for everyone. It's a helpful change for many people, but it does come with caps and phase outs, lots of definitions and implementation details. So your advisor can help you explain the rules to help maximize the benefit. Just an update on some states that we have learned about. These just kind of stuck out. Colorado is not conforming. Illinois has a few updates here. Has also not adopted no tax and overtime. So states are slowly but surely coming to the surface. And Maine is another state that is not conforming. And of course, unfortunately, our New York State will continue taxing both the tips, like I said, and overtime by adding new codes to a form IT 225, which is all of the additions and subtractions to federal income. And so this will be the add back of exempt overtime pay. And in the case of tips, the add back of exempt tip income. So lots more to come, but do consult your tax advisor for any questions on eligibility or phase outs or anything of that nature. I think that's all I've got. Thank you so much. Oh, and here's, I'm sorry, here's our Schedule 1A. This is the excerpt in Part 3 that will allow you to calculate your employees or your overtime deduction that you qualify for. And this is going to feed over onto other parts of the tax return, ultimately onto the 1040. So more forms, more instructions, and all kinds of fun.
There we go. Good morning or good afternoon, everybody. My name is Stefan Swiner. I am a tax principal here at Tronconi Segarra and Associates, and I am going to be going over all of the depreciation changes in the new tax law. So to start, we're going to start with bonus depreciation. So bonus depreciation under the old law, the Tax Cuts and Jobs Act, it was set to sunset after the tax year 2026. So there's going to be no more bonus depreciation allowed. Under the OBBB, bonus depreciation is fully restored to 100% permanently going forward. This applies to all tangible property with a class life of 20 years or less, computer software, qualified improvement property, and certain other property that is acquired and placed in service after January 19th, 2025. That's a very important date. You're going to hear me say that date quite a bit in the next couple minutes here. The property can be both new or used property, both qualify for the 100% deduction. And when determining the property's acquisition date under the existing guidance, if the acquisition of property is subject to a written or binding contract, that's a very important term, that is entered into prior to the manufacture, construction, or production of the property, the taxpayer must look to the terms of the contract to determine the property's acquisition date for purposes of bonus depreciation eligibility. This is really only going to come into play for projects started in early 2025, as anything entered into post-January 19, 2025 is going to qualify for 100% bonus. Property that is self-constructed by the taxpayer is going to be deemed acquired when the manufacturing, construction, or production of the project begins. And just a quick update on the application of bonus depreciation to used property. So as I mentioned before, used property is eligible for 100% bonus depreciation, but there are some certain requirements it has to meet. First, the property must not have been used by the taxpayer prior to its acquisition, and that's using a 5-year look-back rule. The property cannot be acquired from certain related parties or control group members, and the property's cost basis cannot be determined by reference to the basis of other property held by the acquiring taxpayer. And that means essentially in a like-kind exchange situation. And as under the previous law, taxpayers may fully elect out of bonus depreciation for an entire class of property for any year. Additionally, the new tax law also provides that taxpayers may elect to use the prior 40% bonus depreciation rates instead of the 100% for the first tax year ending after January 19th, 2025. Again, that was the depreciation rates under law. Any assets placed in service before January 18th, 2025 still have to use that 40% rate. And now a quick update on Section 179 expensing. The annual Section 179 deduction increases from $1 million a year to $2.5 million with an asset service phase out threshold of $4 million. And that phase out is increased from $2.5 million under the old law. The changes to Section 179 are effective for property placed in service after December 31st, 2024. So you get the entire 2025 tax year to claim this enhanced 179 expense. Going forward, both the deduction and the phase out threshold are going to be indexed for inflation in future years. Just a quick state tax note here, Section 179 expenses look more favorably on in New York as they allow the full 179 expense. They do not recognize bonus depreciation, so there may be some unintended state tax consequences related to this 100% bonus depreciation extension. And then next up, I will cover the biggest and probably most exciting depreciation change that's brought about in the new law. The OBBB adds a new provision that provides special 100% expensing for a new class of property, and that's known as qualified production property. The new rules allow taxpayers to elect to fully deduct amounts invested in QPP in the year the property is placed in service. So what is qualified production property? QPP is defined as any portion of domestic non-residential real property that meets the following requirements. The property is used by the taxpayer as an integral part of what's called a qualified production activity. And that is a new term that I will touch on momentarily. The property is placed in service within the U.S. or possession of the U.S. The property's original use commences with the taxpayer unless an exception applies. And again, I will discuss that later as well. Construction of the property begins, here's that date again, after January 19th, 2025 and before January 1st, 2029. The property is placed in service before January 1st, 2031, and the property is designated by the taxpayer in an election on the taxpayer's income tax return. QPP does not include any portion of non-residential property that is used for offices, administrative services, lodging, parking, sales activities, research activities, software engineering activities, or other functions unrelated to a QPA. So why is this a new exciting provision in tax code? Non-residential real estate is generally capitalized and depreciated over a 39-year period. Now, if part of that non-residential building qualifies as qualified production property, a full 100% deduction is going to be available in the year that is placed in service, and that's going to be leading to a potential large tax savings in that tax year. So continuing on, as I mentioned earlier, the IRS has a new term, which is a qualified production activity. And a QPA includes the manufacturing, production, and production is limited to agricultural and chemical production and refinement of a qualified product. A qualified product is generally defined as tangible property. However, food and beverages prepared in the same building as a retail establishment in which they are sold are excluded from the definition of a qualified product. This exclusion will impact certain items prepared by restaurants, coffee shops, bakeries, caterers, and businesses of that nature. An activity will also not be considered a qualified production activity unless it results in a substantial change and transformation of the property comprising the product. That is a new term defined by the IRS. The OBB is directing the IRS to issue guidance regarding what constitutes a substantial transformation. However, this definition is still very vague and no official guidance has yet been released related to the QPA's definition of a substantial transformation. And one final point regarding the QPA and QPP, the property that otherwise qualifies as a qualified production property but is leased by the taxpayer to another party, including related parties, will not be considered used by the taxpayer as part of a qualified production activity, regardless of how the property is used by the lessee. Therefore, any renting and rental income of a building that someone else is using for qualified production activities will not qualify as QPP for the lessor. So going back to the original use exception, there is an exception to the original use applied to acquired QPP, meeting certain additional requirements. The original use exception essentially applies to the purchase of a pre-existing building, not a construction of a new building. These new requirements must include that the taxpayer acquired the property after, again, January 19th, 2025, and before January 1st, 2029. The property was not used in a qualified production activity by any person between January 1st, 2021 and May 12th, 2025. The property was not used by the taxpayer at any time prior to its acquisition, and the property was not acquired from certain related parties or, again, in certain types of transactions where the basis carries over from a seller or a like-kind exchange. If these requirements are met, then the purchase, building, and QPP requirements will qualify as qualified production property and will be eligible for 100% expensing. And then just to clean up notes on QPP, QPP is also subject to the written and binding contract rules that I discussed earlier. And also mentioned that unlike regular bonus depreciation, taxpayers must affirmatively elect to expense qualified production property for each taxable year that it is claimed. The election is going to be made with the taxpayer's income tax return for that year. However, the exact manner of making the election is not yet known and will be prescribed in future IRS guidance. And that's all I had for depreciation updates. I'm going to hand it over to Connor.
Good afternoon, everybody. My name is Connor Schaefer. I'm a supervisor here at TSA. I'm going to chat with you a little bit today about some of the the history and changes with some R&D, also known as R&E, depending on the context in which you're talking about and expenses. So you might remember that one of the more unpopular provisions of the Tax Cuts and Jobs Act back from 2017 that was put into place basically said that all R&D expenses, for the most part, were no longer eligible for immediate deduction. They were subject to either a 5 or a 15-year capitalization and amortization, depending on whether they were domestic or foreign costs. You know, that hit some industries fairly hard. Personally, we had some software clients here, you know, different industries that all of a sudden were used to having 6 figures worth of expenses a year for their continual R&D costs to all of a sudden not being able to deduct those at all. With the One Big Beautiful Bill, one of the, I think, the better business-friendly changes that went into effect was those expenses are now largely eligible for immediate expensing. So we'll get into some changes that were also potentially retroactive for some clients, but on a go-forward basis for all taxpayers, the capitalization of those expenses is generally going to be elective in most circumstances. And the immediate expensing will be allowed. So for small business taxpayers, they actually kind of get a couple of different options as to what's going to happen with both current expenses and the prior expenses. So the One Big Beautiful Bill, in addition to changing what is happening prospectively for all businesses, also allows for small businesses to retrospectively make these changes. So we'll talk about the specifics for that in a little bit. But for unamortized costs for all taxpayers, you can do something in years beginning after 12/31/24, excuse me. So for your 2025 tax returns and beyond, you are generally allowed to elect to deduct the entire remaining balance in the first taxable year. So if I'm somebody that, you know, over the course of tax years 21, 22, and 23 has capitalized, let's say, you know, $500,000 worth of costs, I still have $400,000 of those costs unamortized. I, in theory, would be able to take the entire balance of that deduction in the 2025 taxable year on my 2025 taxable in my 2025 tax return. The second option is to amortize the remaining balance ratably over 2 years. So, you know, same thing, anything after 2024, so 2025 and 2026. So in my example, I'd be able to take a $200,000 deduction in 2025 and a $200,000 deduction in 2026. There's a couple of procedural requirements here. There's nothing wildly daunting to take care of. You basically just have to make an affirmative election statement on your tax return. It's pretty simple. You have to follow Revenue Procedure 2025-28. There's nothing overly complex. It's a very small written statement that's going to wind up being attached to it. The other option, and I kind of skipped over from the beginning of the slide for your taxpayers, is you can wind up just treating them as if the law hasn't changed. So the default position is as if the TCJA requirements were still in place. Anything new that is put into service or any new R&D costs, I guess, that are incurred in 2025 and beyond, those will be treated under the new rules. However, anything that was capitalized previously, I could choose to continue that. You know, there's any number of reasons why we may want to leave those assets for certain taxpayers. It's going to be facts and circumstances specific. For those of you who are not looking to have your expenses trapped up and you would like them immediately, not really going to be an option that you're going to want to explore, but we'll talk about maybe why that might be an option for other taxpayers. Excuse me. So for small business taxpayers, and that's going to follow the same sort of gross receipts threshold that you'll see for lots of other areas of the law, you know, such as, let's say, like a 163J limitation, that sort of thing for business interest. We are talking taxpayers who are under the $31 million gross receipts threshold. So that'll probably be, you know, most of us on the call, and for any practitioners on the call, that's going to say most of our clients, right? So eligible small businesses can elect to retroactively, as I mentioned before, apply the new expensing rules to the old open tax years. So if I went through and I was expensing things every year, I can absolutely choose to go back and make amendments to my prior period tax returns that will allow me the benefit of taking those deductions in the original tax year. That's going to be facts and circumstances dependent as to when you're going to want to do that. So I really encourage you to talk with, us or your tax advisor, or really look at your own specific tax situation to determine whether or not that makes sense. For certain clients, it's going to be truly a cash flow reason. Hey, it looks like it'll be more in 2024 versus if I take the benefit now in 2025 because my income might be lower or something like that. There's not a universal benefit, so you're really going to have to look at your situation and figure out when that would be beneficial for you. So like I said, just to recap that, it's going to be elective. That's not going to be the default position. I don't believe I put it on the slide, but they're going to, you're going to need to make a decision on those amendments by the sooner of July of 2026. Or the expiration of the statute of limitations for when you filed your tax return. So for 2022 tax years, you're really going to have to look to see when that return was filed. Because if you filed it on extension and you filed it after July of 2023, you're still good after that July of 2026 date. Potentially, you might not be. It's really going to depend on when you filed your tax return, but for everything else, should be a little bit of an easier lift. So this is what I was saying, some considerations before we make the election. So some things that we have to pay attention to, this is pretty common for anybody who has capitalized R&D costs. A lot of times we are also taking the research and development credit. If you are somebody who was taking the R&D credit before, in addition to having these capitalized costs, you may have some interplay you have to think about with the application of the modified R&D credit. Which realistically is just you have to take a reduced percentage across the board in order to not factor certain things into the overall R&D calculation. If you are a client that has foreign operations, or if you are a client that has the FIDI deduction, you may have reasons to want to not take an extra expense in the current year. The limitation on this will be a big one that I think will impact a number of clients that I'll probably also have to consider for mine. The next one is the limitation of business interest deductions under 163J. You may find yourself in a situation where I wind up going back and I wind up saying, oh, hey, great, I can take, this big deduction back in 2023 for, R&D costs that I wasn't able to before, but then I'm going to wind up now taking a big haircut on my deductible business interest limitations, depending on where that puts my adjusted taxable income. Another not as common one, but it is one that I've seen some practitioners talking about online, especially if you're somebody, who's, let's say, in early stages of your business. If you're a C corporation where I have large R&D expenses that are potentially putting me into loss scenarios, we wind up living in a world where that could have potential Section 382 issues, which really are only going to come into play if I'm looking to sell. Or if there's going to be ownership changes in the business, I could have some serious loss limitation implications. So interplay with the R&D credit under Section 41, we kind of just talked that a little bit. We're really just going to have to make sure we're paying attention to the reduction in costs unless I make the election for the simplified credit. Really want to make sure that we're paying attention to the whole picture. We often find ourselves in situations where, the tax law changes and all of a sudden I'm going back and I'm saying, oh, hey, I can make this one really cool big change. I know it's going to save my taxpayer and myself a lot of money, but we find ourselves in situations where, the intended consequence of that is not necessarily what winds up coming into reality, because we can see, hey, oh yeah, I've got this now big deduction, but I'm reducing my credit unintentionally, or the things with the 163J that we mentioned before. This is going to be a big one because, like I said, in my personal experience, most of my taxpayers who have capitalized R&D costs are also taking the credit. So you're really going to want to make sure that you're working with us or working with your tax advisor to ensure you're not going to get screwed by going back and doing this retroactively. Then just a quick summary of all the things you've got to pay attention to. So for retroactive expensing, just like I said, small business taxpayers only. You're going to amend your return, or in the case of certain partnerships who have not elected out of BBA, we are going to have to file administrative adjustment requests. And like I said, we've got to do that by that July 6th deadline. I did put that in my slides. Happy surprise. I thought I left it off. The accelerated depreciation or amortization of unamortized costs, that can be done by anybody. That is going to be, like I said, the default position unless you elect into one of it's going to be the you're going to have to elect into that position. It's not the defaults. You're going to do that either just in 25 or in 25 and 26. The choice is yours. The election for that is kind of similar to what had to happen several years ago when these rules went into effect in the first place. Didn't have to file for an actual method change with the IRS, despite the fact that this is considered by the IRS a method change. You're just going to have to attach a written statement to your return, and that is due with your 2025 return, including extensions. So the late or revoked section 280C, that's that simplified credits that we were talking about before. You got to also look out for that same situation. If you're looking to make a modification to what you did in a prior period because you're looking back to do retroactive expensing, you're still going to have to file a similar statement. We got to look at that revenue procedure, and we've got to do that as well by the earlier of July 6th or the refund statute expiration. And that, I think, covers all of my my R&D topics, and we'll pass it over to Kevin.
Before I pass it to Kevin, a question came in for you, Connor, as you were talking. Can you just, by William, can you decide to take the deduction anytime in the future? In other words, can you pick a year in the future to take the retroactive deduction?
Sure. So realistically, what's going to happen is we're going to have to make that decision by the time we're filing our 2025 return, because by the time we are filing our 2025 tax return, we're going to have to make a decision what we're doing with those costs in 25, and what we're doing retroactively will impact what's happening in 25. So by way of saying, you're going to have to decide by March 15th or September 15th in general, or let's say 4/15 or 10/15, if you're going to take that back in 2022, 3, and 4. I can't let's say wait and go into my 2026 tax year and then go back and decide for, hey, I didn't like how I did it in 2025. We're going to make that election in 25, or we're going to have to make that position known in 25, and we're kind of stuck with it at that point.
Okay, great. Thank you. All right, Kevin, you're up.
There I am. All right. So thank you everybody so far for giving some great information. Just as a reminder, if there's been something in this presentation that you wanted more information about, I would refer back to our July presentation. We covered a lot more topics at that point in time. So for my job today, I'm here to talk about section 1202, and more specifically about the capital gain exclusion that results from that. A lot of people may not know what this section is, so I'm hoping to give a little bit of a background for our attendees here, and then see the changes of before the new tax law and what is happening after, since this section has been around for quite a bit now, or quite a bit of time. Back in 1993, the Congress has enacted this section, section 1202, and it's basically an encouragement investment tool for shareholders to invest into small domestic C corporations. The key word is C corporations. If you are any other entity type, you're most likely not going to be qualifying for this exclusion unless there's some sort of restructuring going on. This investment opportunity basically allowed for stock that was issued after August 10th of 1993 for those domestic C corporations to claim a 50% exclusion of capital gains tax when that stock was sold. The key word is that it's stock that is sold, not assets that are sold. The exclusion rate was then increased to 75% after February 17th of 2009, and then increased to 100% in 2010. So more information about the general background, certain types of corporations, those are performing in certain services, like attorneys, accountants, consulting, engineering, architecture, banks. They unfortunately will not be allowed for this exclusion. We see this a lot in what they call the QBI world for qualified business deductions. We see some limitations there as well. So it seems like they're almost have a a bad way and sour taste in someone's mouths about it, but it's just something that's out there and it's kind of stayed there, and it has not changed since the tax law was released in July of 2025. Some more information about general background. This exclusion we're talking about, the 55 or 50%, 75%, 100%. Generally, that exclusion did have a limitation on it, and usually you cannot exclude more than $10 million of your gain or 10 times the investor's stock basis. So if you had a company that was a startup, they put $3 million into it, say in 2015 when there's 100% exclusion, potentially your gain could have been, say, excluded for $30 million instead of the $10 million that we see on a lot of headlines. So I think that's a key point to bring across to some investors. Another key part of this is that in order to receive the exclusion, you have to hold the stock for 5 years according to the laws before the OBBB was released. You also had to have a certain test you had to pass to make the stock be eligible for this exclusion. At the time of issuance, you would have to have less than $50 million of gross assets. So it's an asset test that is ever living as well. So you could potentially go over that limit after the stock is issued and still qualify, but it would have to be based on organic growth, not based off of continued contribution. So they are still incentivizing people to grow larger, but they want to make sure that there's a lot of contributions that bring you over that limit overall in the company. Typically, these gains that are not covered by the exclusion would still be taxed at ordinary rates. For the long-term rates, you're talking 15 to 20% on a federal level. Also, you're going to have a state tax rate as well. But this is also subject to the 3.8% net investment income tax, which is basically for individual taxpayers that make more than $200,000 to $250,000 a year. So it might hit a lot of people that are on this phone call. So essentially, in order to maintain the status during the holding period, you must be some sort of active test. So this is not only is it limited to certain industries, but also to certain corporations. So if you have a lot of passive investments, you're most likely not going to qualify for this. And it's a test that's ever going as well. You basically have to have 80% of your assets on your books be a part of an active business, whether it's used in operations, development, manufacturing, sales, your R&D costs. Basically, they want you to keep your passive assets minimized. We kind of touched upon this already, but they essentially want you to still grow your company, but you have to keep documentation that shows that the statutory limit that was put in place for $50 million for gross assets is not exceeded by your contribution growth, but more of your organic growth of operations. So now we have some changes that have happened, right? This is the good stuff that everybody wants to really know. When there are changes going forward after July 5th of 2025, there are still all the old rules that still apply. So if your stock was issued before July 5th of 25, you still have to follow all the same rules of the 50% to 75% bucket, the 100% bucket. Those are all going to stay the same. If you did get stock after July 2025, there are some different increases and new buckets in terms of timing. So the increased limit from last time, so it was $10 million for the last probably 30 years or so since 1993, but that is now increased to $15 million. The 10 times the investor basis is still there, so there's no change on that. Another key is that the $15 million is now going to grow with inflation starting after 2026, and it's not a set in stone amount like it was in the past. So I was talking about holding period changes. So in the past, we had this 1 5-year window. You had to hold the stock for 5 years in order to receive this exclusion. Now they have introduced a 3-year, a 4-year, and 5-year rule. essentially what this is trying to do is allow people to invest into these C corporations, and after 3 years, if you decide I want to get out or I have a good offer available to me, I can still receive part of this exclusion. So what they've done is they've offered an ability to receive a 50% deduction on the, or exclusions, I'm sorry, under 3 years, if you hold the stock for 3 years, 75% if you hold it for 4 years, and the full 100% exclusion after 5 years. So another change that this happened is they have, I think because of inflation, this really came out a few years ago now, obviously, they have raised the limitation from $50 million to $75 million for the gross asset test. The caveat is that we have the shorter year thresholds now of 3 and 4 years instead of having only 5 in the past. But if you fall under the 50 or 75% rule going forward, you're going to be subject to a 28% federal income tax rate plus net. Versus if you hold it for 5 years, you still have that super preferred 15 to 20% tax rate. This is just their way of saying if you want to get out, you're still going to get to receive a exclusion, but you might pay a little bit more tax on that non-excludable amount. They really want people to still stay in there for 5 years and keep that money there. So those are really the changes that have happened. There's overall, basically, they've allowed this 3, 4, and 5 year bucket change. They had some gross up for the amount of the exclusion. And outside of that, a lot of the basics of it have still stayed the same. Some other considerations for this section, we see some people that have tried to expand their amount of exclusion by doing some gifting of stock when that opportunity comes for the sale. Essentially, it's on a per taxpayer basis, so you can essentially grow that exclusion exponentially by gifting your stock. Also, there are still opportunities for reinvestment. So if you sold your stock for $20 million, you got a $10 million exclusion, you can essentially push that $10 million that would have been taxable into another QSBS opportunity, which will defer that tax to the next cycle, to your next QSBS opportunity. Those rules have not changed since before QOOB, so they're still the same. I know there's been some conversations in this presentation about New York not conforming to the tax law changes and tax law benefits. QSBS is still eligible under New York, so you're still going to receive those exclusions. So yay, a win for us for New York. But essentially, the rules for active status are still the same. The rules on capital contributions are still the same. So you got to really keep documentation on board with your company. You're going to go down this route. They're going to have a written plan put in place and just decide when your holding period is going to be, when you're going to sell, product development, and really just show that you're still an active business. So if anyone wants to take a peek to see if your company was eligible, you have the proven backup for it. And outside of that, that is all I have for 1202. I think we're going to take it back over to Carolyn now, because I think there's some questions that are in our queue here. We'd like to get to those before the end of the call.
Yes, we do definitely have some questions in. I just want to give everyone a minute to be able to put any remaining questions in, and I will turn it over to our experts. As our experts are back on camera, I am going to send out our last poll real quickly based on what you learned today. How are you feeling? Hopefully everybody is not going to select me. I am confused, but hopefully we had some good education here today, and I want to thank our experts for joining us. How are we thinking, guys? How do you think you did? Everybody going to be good to go now after tonight? I think so. All right.
A lot of information out there.
There was a lot. We covered a lot, so.
Still a lot of guidance to come.
All right, I'll give everybody just another minute to fill this, or a couple seconds to fill this out. And close it in 3, 2, 1, so we can get to the questions that people past. Just share real quick, a lot of people in good shape. There's still a couple people that have some questions and we'll need to follow up with. And some people that are still slightly confused. So those that are still confused, we will reach out to you or reach out to us directly and we'll get those answered for you. But let me jump over to questions. Diana had a question. Let's see who wants to take this one. Due to the changes in 2026, will there be any deduction for employee meals off-site that are business related? In addition, if an employer meets with a client for a meal, would that be deductible in 2026? Who wants to take that one?
I can take the offsite part of it if you want, the employee recreation, so picnics, holiday parties, et cetera, primarily for the benefit of employees. Other than those that are highly compensated are still deductible at 100%.
Okay, anybody want to add to that? Hopefully, Diana, we answered that for you.
Sure, I can jump in. There's one key change in 26. These are going to be applied to employer provided meals for convenience / on-site facilities. So meals that are provided on employer's premises or employer operated eating facility for the employer's convenience, such as break room coffee, snacks, and cafeteria meals. Those are going to now be 0% deductible. So that's going to require some record keeping going forward.
Great, thanks, Lisa and Stefan. We have one that came in from Walter. Does 2,000 limits for 1099 apply to 2025 payments? Sorry, small text here.
That's going to pick up for 2026. So for 2025, the $600 threshold still applies for 1099 reporting for NECs, but that $2,000 threshold is going to go into place next year. And I also believe that it will be next for inflation going forward.
Great. Thanks, Connor. Another one from William. If you have your business in an S corp or partnership, are there any circumstances that would conclude to convert to a C corp?
I'm going to go ahead and say that is a question that is very facts and circumstances dependent. There are plenty of reasons when that would be very beneficial to you, but there are equally as many times when that would be more harmful to you than good. So I'd encourage you to reach out to any member of your tax team and we can get that discussion rolling.
Great. There's a couple more that came in. It looks like people are putting them in. So if you have a question for what's in there, the bill was passed on July 4th, 2025. Does that mean all the tax law changes took effect July 4th, or was that beginning of 2025? What are we looking at? We have two different sets of records for keeping.
I can take that one. Yes, the tax provisions of the OBBB became effective at various times, with many of the changes applying to the 2025 tax year, and then the majority of the permanent changes taking effect on January 1st, 2026.
Great, thank you. And one last one looks like, at least this might be coming to you from Janet. If your spouse earns holiday pay or occasional double time and a half, would any of these special types of pay be excluded from tax?
The only part of the overtime that is excluded is going to be the half of the time and a half rate. So no, neither of those would be just the half portion of the time and a half.
Great, thank you. Well, I do want to let everybody stay on track today. We're just over our time. If you have questions, feel free to reach out to us and we'll get them answered for you. Happy to set up any one-on-one meetings with any of our experts. We thank you for joining us today, and always can check out our past webinar recordings on our YouTube page. Always follow us on LinkedIn so you can find out what our 2026 topics will be and those dates. And thank you, experts, for all that information and sharing that with everybody today.
Absolutely. Thanks for being on, everybody.